we're going to do a twofer here, folks. We've got IBM Q3 earnings, and IBM introduced some very provocative enterprise LLMs, which I'll let Daniel talk about first.
So I'll start off. I'll talk a little earnings, and then maybe we do the second part. Let's talk about the Granite 3 launch, because it is a bit of a twofer, and there is a bit of a thread to tie it all together, Pat. But you and I had a great opportunity to sit down with CFO Jim Kavanaugh on earnings day, get the rundown from the company. It's sold off pretty hard in the wake of its results. Revenue growth was seen as a little bit slow. Now, this is a company that's historically been valued more on free cash flow than on growth. We know that under the Remedi era, it didn't grow at all most of that time. We know in the Arvind Krishna era, it's been kind of what you would call low and mid single digit growth. This era has been the hybrid cloud and AI. I think we both agree, and we've said many times, that the company's focus has been better in this era. I think the spin-off of Kyndryl, the removal of certain parts of the business that just weren't priority, weren't focus areas for the company, has been good. You know, it's a strategy of sort of playing hybrid cloud and playing partner to the hyperscalers as opposed to really meaningfully trying to compete has served the company well. But I think there's been a lot of what I kind of call, puts and takes, push and pull with the company, where once some part of it starts to grow the way it should, some other part starts to pull back. It's got the cyclicality angle to it. So it was a very tidy quarter from an operations and finance standpoint. The continued ability to create cash flow, to deliver op inc and percentage op inc has enabled the company to at least show growth and kind of continually hit the EPS results that it's been promising to the street. The challenge is it's seen this great growth. I mean, you're talking about a $3 billion order book on AI, about what I think we heard a number of something like 4/5 of that is consulting. The rest of it is software and the Watson family. And this is, really encouraging. Having said that, somehow consulting isn't growing, which is a weird thing. Like, you got all this demand, all this interest, and all this need for consultants to be able to deliver and implement generative AI. They've got a great platform. I think the first real enterprise end-to-end AI data governance platform. And yet, like I said, with all this order book, all this demand for consulting, the growth of the company's low single digits, the growth of consulting is actually negative. And so this has been the interesting area to sort of navigate, is how does the company deal with it having this powerful tailwind with AI, but kind of core technology consulting is down, core hybrid infrastructure is down, Z is late in cycle, and anytime Z gets late in cycle, that really hurts the infrastructure number for the company, because the good news is there's a new wave coming. The bad news is that tail end, the revenue falls off hard, and therefore it becomes more and more pressure on the company to make up for that. The only other thing I'll say is that, as we've moved to AI, it's very clear that the reason IT budgets are flat is that all the spend has moved to AI, and all the other spend is basically just stopped right in its tracks. That's why you see on the chip side, CPU growth is on data centers down to nothing. And so if you don't have the ability to sort of augment a lot of revenue over to AI, and you're not getting enough there, you'll actually see a lot of growth get offset. And that's really what's happened here with IBM. There's no way to kind of split hairs about that. The good news, Pat, and I'm going to let you comment on earnings, and maybe we go to Granite after that, is I do think the technology for the first time really is showing some strong market leadership. We're seeing that with customer wins. They're seeing it with use cases. They're seeing it with outcomes that consulting is driving. It's kind of one of those situations where all the good things haven't happened at one time for IBM in a long time. So, we've seen some good Red Hat results, or we see some good AI number results, or we see a good consulting result, or we see a good Z, but almost never all these things in one quarter. And so that's why it's kind of all been kind of at that low single digit. But to the credit of the company, it's dealing well with the fall off of the more legacy businesses. It's done a good job offloading them. It's done a good job of offsetting them. And that's why at least the company continues to grow. And the stock, while it's fallen hard on this earning, actually over the last couple of years has been a really good performer because the company's been so consistent.
Yeah, that was a great breakdown. And yeah, I was surprised. You would expect consulting to be off the charts. And then what you do is you look at the industry, where Accenture just got back to growth. So I am expecting that IBM will get back to growth with consulting. And, I think, I asked Jim twice about consulting to break it down. And at the end, after a little bit of research, it made sense for me that those dollars are moving from consulting to doing POCs. You might think that, well, doesn't it take consulting to do a POC? Not always. And again, at the end, I look at Accenture, then just getting back to growth. I'll do a side eye if we don't see some growth next quarter because IBM would not be moving with the market. But let's look at some of the bright side here, right? AI backlog is up 50%. Red Hat bookings year to date, subscriptions up 20%. And with that carry stuff like Ansible and everything through it. ARR book on the software up double digits. So while that single digit number is single digits, there were some areas of growth where you would expect that growth to be driven from. The other thing I want to talk about is infrastructure, right? IBM Z is in the longest span of riding the current product line in the history of Z, and we saw it this quarter, right? Infrastructure was down big time, and typically, it has been, one of the, I don't want to call it a savior because that's that's probably doing it too big, but they were just absolutely crushing it. They've been riding current infrastructure for about 3 years. There is a new platform that's coming out in the first half 25, which should boost that. And again, there's two feeders to downstream revenue for IBM. It's infrastructure and it's consulting. And if both of those aren't hitting in the same quarter, you're going to get what you are going to get. But hey, Daniel, let's pivot to the future here and talk about these Granite 3.0 models. So the company came out, made what I think is its biggest announcements in AI, aside from when it first came out with Watson X. So this is the third edition of these Granite 3.0 models. And to be very specific, these are for business. These are not for consumers. First is one called Guardian, and that's for guardrail capabilities. The other one is an MOE, a mixture of experts, super low latency for CPU deployments and edge computing. You've got time series for zero few shot forecasting, very, very high performance. You've got Code Assistant that IBM has had a really good track record. And the overall comment I want to make here is that obviously by 3.0, these aren't the first models, but for the first time, the company is hitting not only on performance, and that's accuracy, but it's also hitting on efficiency. And the reason to believe here that these are better for business, and again, we have not done the testing at Signal 65 yet, but I do like the figures coming out from IBM that they look really good, is that they don't test on world data. They don't test on golf scores. They don't test on the history of sports. They're not testing on recipes, vacations. And therefore, your data set is smaller, but your data, and that means it's going to be higher performance. So for something that might take 100 B models, they can do with 5. And I'm just throwing out numbers that aren't the exact numbers because they vary. And what does a smaller model mean? Is you don't need a Blackwell to run these models on. You can run them on the CPU. You can run them on an NVIDIA L40. You can run them on a lower end AMD, which could make them 10 to 20 times less costly to run your applications. This is IBM's big move. They need to pour on the gas on the promotion side, on the selling side, on the collaboration side with their partners like Adobe and with SAP to make a resounding exclamation point on this. And from a positioning standpoint, the company needs to be very clear. There are models that are optimized for consumer, and there are models that are and services that are optimized for the enterprise. And clearly, this is for the enterprise. Good job, IBM.
Yeah, Pat, you hit it. And so I'll just double click on a couple of things. The future for most enterprises will be smaller, dedicated, focused models. Okay. IBM, interestingly enough, it has a unique opportunity to be, and I say this very cautiously, but openly, a real alternative to the sort of NIMS, NVIDIA, and ecosystem. Okay. The idea of being able to build industry models through the combination of smaller models, through the combination of having the data AI governance model, of having infrastructure access, and of course, being able to take great, deep expertise into specific use cases is really the idea. Now, how that gets done can vary from company to company, from technology stack to stack. But where it all starts is having high fidelity, very accurate models that deal with language or deal with a specific use case. And that is something that IBM is doing really well. And Pat, this stuff changes. It's incredibly fluid. And so this is a moment in time. The moment in time could change. And as we look at the possibilities and what could change, you need to understand that, this is something that's fluid for the enterprises adopting it. Now, what I will say, and I kind of end here because you covered this so well, is that enterprises move at a different speed than the cloud. Okay. And so this is what I really like IBM and this kind of idea of generative AI for the enterprise, Pat, is that enterprises are going to be looking to solve problems. They're going to be looking very cautiously at data. Governance and compliance are big concerns. Their ability to move at the speed of innovation in the silicon space is going to be slowed. And so they kind of have a couple of ways to address this, but there's a ton of need. Our data has shown this endlessly for capability and capacity, for specialty expertise. And so what I really liked, and I sat with Rob Thomas last week, is I liked, I was talking to him, is I like the idea that they can bring together technology and consulting to implementation and do so in a very uniform way. And Pat, the other thing I like is that IBM is open in the sense of working with other vendors. So, I said competitive to NVIDIA, but they could also work alongside NVIDIA. They could work alongside different public clouds and different offerings. They could work alongside different data lakes if they need to, because they can make the money in consulting, but they can also make the money. Now, the last thing here, Pat, is just to say IBM's gap is the market identifying and seeing that its models are, in fact, really competitive, really valuable, and belong in the conversation. So that's kind of what I'm saying here is after reviewing this, after looking at the data, after looking at the competitive posture, and looking at the power and efficiency and accuracy of these smaller models, enterprises really do have permission to think very seriously about IBM as an alternative to do, cost per token reduction with high fidelity to get enterprise outcomes. And so that's what IBM should be pushing. That's the opportunity and the challenge. And that's where I think the company could go.